All right, let's dive right into this explainer and uncover the mystery of why the financial markets you see on your screens might actually be an illusion. Have you ever looked at a stock's order book, seen massive liquidity, and thought, wow, there are plenty of shares available to buy, only to see them instantly vanish the second a single trade happens? Well, today we are pulling back the curtain on a pretty wild phenomenon known as ghost liquidity. So here's our roadmap for today. We'll start with the illusion of liquidity, move into defining ghost liquidity, and then track the traders. From there, we'll figure out who creates ghost liquidity, where do ghosts haunt, and finally, we'll wrap the whole thing up with the real market impact. First up, the illusion of liquidity. Seeing is not believing. To figure this out, we're looking at a rigorous piece of research today from the European Securities and Markets Authority, or ESMA. Their working paper number 4 investigates this exact phenomenon. They wanted to know how modern, fragmented trading structures might actually trick our eyes and overstate true market depth. Moving right along to defining ghost liquidity, the duplicate order phenomenon. I want to pose this simple but honestly vital question to frame the core mystery we're solving today. It sounds like something straight out of a sci-fi thriller, but it's an everyday reality in our financial systems. Ghost liquidity, or GL, is essentially overstated market depth. It happens when traders place duplicate limit orders on competing venues. But here's the catch: they fully intend for only one of those orders to actually execute. The moment it does, they immediately cancel the rest. Think of it like a job application strategy. It's like applying to 3 different branches of the exact same company just to boost your chances of getting hired. But you instantly withdraw the other 2 applications the very second one branch offers you the position. Understanding these exact mechanics is absolutely crucial. Step 1, a trader places duplicate limit orders on multiple venues. Step 2, one of those orders executes. Step 3, the duplicates are instantly canceled. Now, traders do this to maximize their chances of capturing order flow, right? But they face what's called execution risk, because if they aren't fast enough to execute step 3, they might accidentally buy or sell the exact same stock twice. Which brings us to tracking the traders, 10 milliseconds to catch a ghost. What's really fascinating here is the sheer scale of the investigation. The researchers didn't just look at a handful of random trades. They analyzed 91 different European stocks across a massive data set from May 2013, capturing 10.5 million trades and a staggering 456 million messages. To track this illusion, ESMA analyzed those 91 stocks across primary exchanges and 3 alternative venues: BATS, Chi-X, and Turquoise. And their secret weapon here? Cross-venue group IDs. The researchers were literally able to follow the exact same traders across different platforms in fractions of a second. To make sure they caught the ghosts, they measured order cancellations within an impossibly tiny 10-millisecond window after a trade. I mean, that is well beyond human reaction time. Let's look at who creates ghost liquidity, the suspects. Check out this rapid-fire data reveal. When we measure ghost liquidity as a percentage of pre-trade liquidity, a very clear hierarchy emerges. Slow traders generate about 2.70%. Algorithmic traders bump that up to 3.76%. But high-frequency traders, or HFTs, they are the main culprits at 5.75%. HFTs rely heavily on their lightning-fast infrastructure to manage that execution risk we talked about earlier, which allows them to duplicate and cancel orders way faster than anyone else. There's also a really stark split when you look at principal versus agent trading. Principal traders, meaning those trading for their own account, generate 3.93% ghost liquidity. Agent traders, who are executing trades on behalf of everyday clients, generate less than 2%. So the takeaway here is that proprietary trading firms risk their own capital using this phantom strategy far more than brokers who are just trading for you and me. Now let's talk about where do ghosts haunt, locations, and stock types. When you compare primary exchanges against alternative venues, the data tells a pretty compelling story. While primary exchanges see around 20% ghost liquidity relative to trade size, the alternative platforms see this number jump well over 30% when interacting with each other. It's a massive difference, proving that these phantoms heavily favor alternative, fragmented networks. And it's not just where they trade, it's what they trade. The stocks with the highest ghost liquidity feature a very distinct rule of 3. 1, larger market capitalization. 2, lower daily volatility. And 3, higher market fragmentation. These specific stock characteristics are super memorable for a good reason. Traders actively avoid using duplicate orders on highly volatile stocks because the risk of accidentally buying twice just moves too fast, even for computers. Honestly, the geographical differences are wild too. Look at Spain's tiny footprint at just 0.63%. Then the Netherlands jumps drastically to 27.10%. And then you have the massive illusion in the United Kingdom market, sitting all the way up at 42.18%. The phantom phenomenon is incredibly concentrated in very specific regional markets. Finally, the real market impact. Does the illusion hurt? I want you to just let this number sink in for a second. 19. Here is exactly what that number means. For every 100 shares passively traded by a multi-market supplier, around 19 shares are immediately canceled elsewhere. So if you are looking at an order book, fully believing that 100% of the volume you see is real and accessible, almost a fifth of it might vanish the moment a trade executes on another venue. But wait, before we sound the alarm, we need a reality check. 4.04%. It turns out, the average weight of this ghost liquidity is only about 4% of the total consolidated market depth. So, yes, the phantom menace is economically significant, and it absolutely proves that measured liquidity overstates true liquidity, but mathematically, it's actually relatively small compared to the whole market. And this leads perfectly to the researchers' final verdict. To quote the ESMA working paper directly, the average weight of GL in total consolidated depth does not challenge the liquidity benefits of fragmentation. So, impartially speaking, the overall benefits of having multiple fragmented markets, things like tighter spreads and better competition, they still outweigh the illusion created by these duplicate orders. But I want to leave you with this provocative thought to chew on. In a fragmented market where high-frequency algorithms operate with a 10-millisecond latency advantage, can human traders ever truly trust the depth of a consolidated order book? It really exposes a permanent technological gap between human perception and market reality. Thank you so much for joining me on this explainer, and hey, keep questioning what you see on those screens.